Hello everyone and welcome back to the channel. Today I show you the latest changes in my stocks portfolio and I will go over some exciting movements and interesting news regarding my stocks. I will talk about Google, which is hitting a new all-time high share price every single day, and it is now by far the largest position in the combined portfolio, and in my main portfolio it is now up over 100%. I will also look at Brookfield Corporation Investor Day. This is another stock that is at a new all-time high share price, and despite being at an all-time high, I still think this stock is not expensive at all. I will also look at Alimentation couche recent earnings report and discuss why I believe the stock can have a good year in 2026 despite weak performance in 2024 and 2025. I will also add a new part to my portfolio update videos, and that is taking a look at Wall Street Bets subreddit and see what is the latest lessons, financial advice, and investing strategy we can learn from them. In this episode, we have user Sage Genesis, who somehow managed to lose $50,000 on Google in the last week. This happened when the stock was hitting a new all-time high share price every single day in the last week. You may think he probably had some put options, but no, that wasn't the case. It wasn't even put options. We will look into this magic and see how is it possible to lose so much money when the stock is gaining so much. We have a lot to cover today, so let's get straight into it. Let me start with the portfolio overview. And here I share my portfolio performance with you transparently. I have almost $129,000 in my main Wealthsimple portfolio, which is up 66% or $51,000. And I also have a small $15,000 portfolio in National Bank Direct Brokerage. And we have close to $49,000 in this smaller separate Wealthsimple portfolio, which has shown an impressive 362% return. I manage all of our assets as a single combined portfolio, which I track them here. We are up 85% or 88,000 Canadian dollar from where we started investing in these portfolios, which is almost 3.5 years ago. Let's look at overall portfolio allocation. This is a nice graphical representation of the stocks we hold in the combined portfolio. This is an overall concentrated portfolio with only 11 different companies. The largest holding in the portfolio is by far Google with 18% weighting at the moment. Google was my third largest holding a couple of weeks ago, but the surge in its share price after the strong earnings report and particularly after the judge ruling for their Department of Justice case caused the earnings multiple of the stock to expand significantly, and now it is sitting as my largest holding in this concentrated portfolio. If I look more closely at Google using Yara IQ Stock Analyzer, I can see that Google is up almost 24% just in the last month, and the price to earning ratio is now at over 25. The stock had an explosive month with a streak of good news and analyst price target increases. The sentiment around the stock completely changed in the last month. You don't hear about OpenAI threat to Google moat anymore. And you don't hear about Google being a dead business anymore. The negative sentiment exists when the share price is down, and it will vanish into the thin air as soon as the stock price starts to rise. And that's why you should never invest based on market sentiment. You should always look at fundamentals of a business rather than the narrative and the sentiment. In my Wealthsimple, Google is now up 106%, and I own 100 shares of Google. My plan for Google is to just hold this stock at the moment. I'm not going to add to Google, and I'm not going to sell Google. I think the stock is now fairly valued, and because of that, it is a hold for me at this price point. My second largest holding in this portfolio after Google is Meta with 14% weighting. Meta has also had a similar change in investor sentiment over the last couple of years. It went through a period that nobody wanted to hold Meta to a period that everybody wanted to buy Meta. Similar to Google, I'm going to hold Meta as well. In sharp contrast to a lot of critics that believe megatech stocks are expensive and they are in a bubble territory, I believe at least Google and Meta are not expensive at all compared to their fundamentals. I think both Google and Meta are trading at their fair market value today, and considering the quality of their business, their profit margins, their rapidly growing cash flow, and their huge investment in AI infrastructure, I believe the stocks should trade at a premium to average companies in the market, but they're not trading at a premium. So these stocks are extremely high quality businesses that just trade at a fair value, and that's why I'm not trimming these positions yet. Just to understand how much these two stocks are fairly valued compared to the market average, let's look at a slow-growing company like McDonald's. McDonald's grew its revenue by only 0.2% CAGR in the last 10 years. The revenue was basically flat in the last 10 years, and it is trading for a price to earnings of 26. Google, on the other hand, is growing its revenue by over 18% CAGR in the last 10 years, and it is trading for a price to earnings of 25. You may say McDonald's is a defensive stock, but I believe Google in this day and age is probably more defensive stock than McDonald's. I can live without McDonald's, but I can't live without Google Map, Google Translate, Gmail, Android, Google Chrome, Google Search, and YouTube. And this is the case for majority of the people on earth. Even Howard Marks, who I think is a great value investor, in his recent memo about valuation of stocks in S&P 500, mentioned that he's not that concerned with megatech stocks, and he's more concerned about the valuation of the rest of S&P 500 companies. This is his exact quote. Regarding the valuation of S&P 500, a bit over half of its jaw-dropping 58% two-year total return in 2023 and 2024 was attributable to a spectacular performance of just 7 stocks. Those of so-called Magnificent Seven: Apple, Microsoft, Alphabet, which is parent company of Google, Amazon, Meta Platforms, parent company of Facebook, Nvidia, and Tesla. These are great companies, some of the best companies ever, and these 7 stocks have grown to represent a startling 1/3 of the total market value of the 500 stock index. Because of these companies' greatness, their stocks are highly valued, and there's a popular perception that their elevated valuations are responsible for S&P 500 unusually high average PE ratio. The fact is their PE ratios average out to roughly 33. This is certainly an above average figure, but I don't find it unreasonable when viewed against what I believe to be the company's exceptional products, significant market shares, high incremental profit margins, and strong competitive moats. A lot of Nifty 50 stocks First National Citibank owned when I got there in 1969 were selling at a PE ratios between 60 and 90. Now, that's high. Okay, he continued. Rather, I think it's the average PE ratio of 22 on the 493 non-magnificent companies in the index, well above mid-teens average historical PE for S&P 500, that renders the index overall valuation so high and possibly worrisome. I 100% agree with Howard Marks on this. For those reasons, I will hold both Google and Meta for foreseeable future, unless they enter an exuberance level of valuation, which both of them are far from those multiples today. Okay, next in the portfolio we have Brookfield Corporation with 14% weighting. Brookfield, just like Google, is in a streak of good news, positive media coverage, and analyst price target upgrades. This caused the stock price to hit a new all-time high just recently, but even at these levels, I don't think Brookfield is expensive. Arguably, Brookfield Corporation is still slightly undervalued compared to the fundamentals of the business. Of course, it is not as undervalued as it was 1 year ago, but it is still attractive. They recently had their investor day, and I have a lot of things to say about this interesting presentation. I may reserve most of them for a separate video, but here I just want to focus on one point that Brookfield Corporation management team mentioned in this presentation. They are mentioning that the annualized return of Brookfield stock in the last 30 plus years was 19%, which is much higher than S&P 500 return of 11%, TSX 60 of 9%, and FTSE index of 6%. They then break this performance down into the last 20 years, last 10 years, and last 5 years. And interestingly, returns getting better over time, not worse. In the last 20 years, for example, Brookfield returned 16% average annually, but in the last 5 years, it returned 22% average annually. Which was an interesting point in my opinion, as usually when businesses becomes larger, the growth and therefore the stock return will reduces. But with Brookfield, they were able to accelerate returns of the stock while become a larger company, which is fantastic. I will talk about Brookfield Investor Day in a separate video, but I'm really excited to be a shareholder of Brookfield, and I am looking forward to see what will happen in the next couple of quarters with the stock. After Brookfield in the portfolio, I have Constellation Software with 10% weighting. There is a strong negative sentiment towards Constellation Software stock in the last 2 months, and that started with concerns that AI may eat into profit margins of all software businesses. It might be true for some software companies, but Constellation Software business model is relying on vertical software businesses. The software companies that Constellation owns are not general purpose softwares with a lot of potential customers. They are super niche, and for that reason, I don't believe AI can induce any significant damage to Constellation Software business and profits. I believe Constellation Software share price will eventually goes back to 5,000 Canadian dollar. So this is a great opportunity to buy more shares of this extremely high quality business. I will hold my Constellation shares and revisit the stock after the next earnings report. After Constellation, I have EQ Bank with 9% weighting. Recently, EQ Bank CEO had an interview at the Scotiabank conference, and I plan to cover the most important parts of that interview in a separate video. But in summary, I feel good about the new CEO for now. We should sit and see how he executes his ideas in the next 2 quarters, but at least the interview itself gave me some confidence about the future of EQ Bank. After EQ Bank, I have Alimentation couche with 8% weighting. They recently reported their earnings, and while the numbers themselves were not great, for example, while revenue and earnings per share have seen a slight decline year over year, the overall results was much better than anticipated by analysts. The company's most recent earnings report showed positive same-store sales in the United States market for the first time in several quarters. The company has been successful in promoting bundled meal deals like hot dogs, taquitos with chips and a drink, which are performing well and contributing to food sales. This strategic shift has shown some positive traction and basically is seen as a key growth driver for increased food sales. Alimentation couche performance in the last 2 years was really disappointing, but I think the stock can potentially perform well in 2026. The key components for good performance of couche in 2026 is to deliver consistent growth via organic drivers like food sales and fuel, in addition to share buybacks. I believe if the company can also continue in its small targeted acquisitions in 2026, the stock can experience a bit of multiple expansion as well and goes back to its historical performance once again. This is another stock that would be a hold for me, and I will closely monitor the next earnings report of the company. After couche, I have Louis Vuitton and as well as Novo Nordisk stock with 7% weightings. Both of these European stocks are, in my opinion, undervalued here. At these levels, I am nibbling on shares. For example, I bought 2 more shares of Novo Nordisk just last week. And if I see any major drop in the share price of any of these 2 companies, I am ready to buy more shares. Finally, I have Amazon with 6% weighting, Intact Financial with 5% weighting, and Aritzia with 3% weighting. I bought 1 more share of Intact in the last week, and I will continue to hold Aritzia and Amazon for now. In the last part of the video, I want to take a look at Wall Street Bets subreddit to see what is the latest investing strategies that we can learn. We have this user, Sage Genesis, who somehow managed to lose $50,000 on Google in the last week. I was really curious to see how he managed to lose this much money on a stock that everybody is getting rich on, and found the answer in the description of his post. In simple terms, This user used a bear call credit spread option. A bear call credit spread is a two-part options strategy designed to profit from a stock either staying flat or moving down slightly. They do two things at the same time for this strategy to work. First, the user is selling a naked or short call option. This generates an immediate credit or premium for the user. They choose a usually FAR OTM or out of the money call, meaning the strike price was significantly above the current stock price. At the same time, they do another thing. The second thing they do is that the user is usually buying a long or protective call option. This call option has a higher strike price than the one they sold. This is the spread part of the strategy. Its purpose is to cap potential losses. The user pays a premium for this option as well. So the net credit, the difference between the premium received and the premium paid, is the user's maximum potential profit on the trade. So now how this user, Sage Genesis, lost $50,000. The Sage Genesis system worked for some trades, but his final catastrophic loss on Google stock was the result of a black swan or unexpected event that completely invalidated his strategy. After Google announced that it won the major lawsuit after the market closed, this caused the Google stock to jump 7% in after hours price. This was the critical point. The spread's value, the difference between the price of the two options, widened dramatically due to stock jump. So the 50% capital was likely the collateral required to place these trades, and the loss was directly debited from that account. In short, this user used an unnecessary, sophisticated, high-risk strategy that worked until a single unforeseen market event turned their high probability bet into a catastrophic loss. Even his fellow Wall Street Bets Redditors mentioned this to him. You didn't lose it on Google, you lost it on options. And another user mentioned, losing 50K on Google, right when everybody making money on Google, is a special badge of honor. Let's not make big mistakes like user Sage Genesis in our investing journey. Thank you for watching, and I see you guys in the next video. Farewell.